Friends, we have in the part one we discussed or we have dealt with that is Financial Stability Development Council. Now we are going to discuss the Financial Sector Legislative Reforms Council. So being this part two, okay. So in fact, the financial sector reforms started in India after 1991 with the committee recommendation, with the Narasimhan Committee recommendations. Prior to that, it was observed that the financial sector was facing various problems, that is mainly that of financial repression, which include extensive regulations, administered interest rates, then directed credit programs, then weak banking structure, then lack of proper accounting and risk management systems, then lack of transparency in operations. These were the problems the financial sector was facing. In order to overcome this, in order to overcome all these problems, the government of India has constituted a committee under the chairmanship of Mr. Narasimhan, who was the 13th governor of Reserve Bank of India. The committee was set up in 1991. And what was the objective? The objective of the committee was to suggest remedial measures for strengthening the banking system, which encompassing so many. There is, first of all, the banking policy. The committee was to examine this by first one, banking policy, remedial measures, then institutional structure, then supervisory system, then legislative and technological changes. These were the areas they will have to examine. And this committee, they have submitted their report wherein they have given the certain parameters or certain areas for suggestion, or we can say that the major contours of the reforms. The first one, the contours of the reforms, which includes removal of the erstwhile financial repression. Whatever repressions we said, we just touched the repression. That removal of that is the first, the main task they have suggested. It should be removed. That is removal of the erstwhile existing financial repression. Then creation of an efficient, productive, and potential banking financial sector. Enabling the process of price discovery through market determination, because that was one of the financial repressions, that is interest rate, dictated interest rates. Now it should be removed. Enabling the process of price discovery by the market determination of interest rates that improves, allocate the efficiency of resources. Then providing operational and functional autonomy to the institutions. Providing operational and functional autonomy to the institutions. Then preparing financial system for increasing international competition. Opening of external sector in a calibrated manner. Then promoting financial stability in the wake of domestic and external shocks. These were the broad the framework or broad suggestions given by the committee. Then immediately the government and Reserve Bank of India took the actions, or after accepting these committee suggestions, to almost in toto, and they have first to begin with introduced the capital to risk weighted assets ratio, that is CRAR. That is just to maintain the stability of the banking system. That CRAR was introduced in 1992. 1991, this committee was formed and submitted a report. 1992 itself, this implementation started. The another one was the SLR, statutory liquidity ratio, which was 38.5, means in 91-92. which was brought down to 28 within 5 years by 1997. Now, there are then CRR, this cash reserve ratio, which was 14%. It was also brought down to 10% by 1997. Presently, again, these reforms are taking place. So presently the SLR is reduced to 19.5 SLR right now, and followed by this CRR at 4%, where was 38.5 and where is now 19.5. Similarly, 14%, now it is 4% only. These are the major decisions, major implementation steps taken by the government and RBI. Then the major reforms they just started implementing. The reforms are also being grouped. Major reforms are in 4 sectors or 4 areas. One is banking sector, then monetary policy, banking sector, monetary policy, then financial market, then forex market. But here we are going to discuss more on banking sector, which is important so far as we are concerned. The banking sector reforms that also can be grouped into various sub areas. That is competition enhancing measures. Various measures can be various measures were taken care of in the banking sector and which are being implemented right now also. Competition enhancement measures, then measures for measures enhancing role of market forces, then prudential measures, institutional and legal measures, then supervisory measures. These are broad, this one. Then let us touch these broad areas, touch what are the areas to be, what are the measures taken under each areas. One, we can say that then institutional and legal measures, supervisory measures, technology related measures. First one is competition enhancing measures. That is autonomy, that is operational autonomy given to the banks. Today, banks are given the autonomy so far as operational aspects are concerned. The autonomy granted and reduction in the public ownership. The government stake, public ownership has been reduced. Now it is only 51%, 49% open market operation it is already given. The 49 and 51, government 51 is the maximum. Then foreign direct investment in the financial sector, that is permitted. Permission to banks to diversify the product portfolio. Product portfolio, that also permission is given. Then similarly, another area is measures enhancing the role of market forces. The sharp reduction in the reserve requirements. As I told you, SLR is presently 19.5. CRR is now 4% only. Where was 38.5? Where was 14% so far as CRR is concerned? Then market determined pricing for government securities. There also the competition, market related pricing. Then market determined pricing. Then dismantling the administered interest rate, deregulation. That is already implemented, and banks are at their discretion to charge or pay interest on deposits, charge on advances, barring some restrictions on the quantum of the interest rate or the rate of interest. Okay. Then increase in transparency and disclosure norms for market discipline. Then introduction of pure interbank money call money market. Developing market for securitization of assets, securitized asset. Then auction-based repo and reverse repo for short-term liquidity management. These are, auction and everything. Daily you will go through the RBI site. You will come to know that this RBI is calling these auctions, tenders. Then prudential measures. Yes, introduction and implementation of the international best practices. That CRAR. Yes, as we already discussed, current this capital to risk weighted asset ratio, CRAR. Then income recognition, asset classification, IRAC. RBI circulars are being issued. provisioning, that also included in those circulars, provisioning requirement. Then exposure, for that also fixed, individual how much, group how much, and that is individual 15% of the capital funds. Similarly, group 14%, and exceptional cases it can be increased also. And the maximum in any case, that is infrastructure 10% each in both the sectors, both the individual as well as group, and the maximum in any case should not exceed 25% of the capital funds in respect of individual and 55% in respect of group. Then strengthening of the risk management, including KYC implementation. Only barring now presently as Supreme Court judgment, barring this, what is that, other related this one, otherwise KYC is a must. KYC implementation is already in full force, and all the banks have confirmed they are fully KYC compliant. Then strengthening of the risk management, that is over. Guidelines for ownership and governance, securitization and debt restructuring mechanism. This is then implementation of the Basel III norms. Our Indian financial system, we are going very much ahead of the Basel Committee 3. That's Basel norms, Basel III norms. Then another area is institutional and legal measures. You will come to know that because you know that there is a setting up of the Lok Adalat up to 20 lakhs can be taken care of there, and this legal Lok Adalat, debt recovery tribunal, debt recovery appellate tribunal, then promulgation of SARFAESI Act in 2002, then comes then introduction of the framework for revival and rehabilitation of micro, small and medium enterprise MSME, that is 2014 it is introduced. The resolution of the trust asset new revised framework by withdrawing some 5 then existing the restructuring schemes of RBI in March 2018. Now only resolution of trust assets, revised framework, and above all the promulgation of the Insolvency and Bankruptcy Code 2016. That is now is a watershed so far as the credit system of the Indian banking is concerned. Then setting up of the CIBIL, Credit Information Bureau of India Limited, for credit rating and other information. Then CAC, that credit information companies, they set up. Presently 4 companies are authorized. Then setting up of CCIL, that is a Clearing Corporation of India Limited, for payment and settlement under the Payment and Settlement Act 2007. Now supervisory measures, then setting up a board for financial supervision, introducing CAMELS, that is capital, asset quality, management, earnings, then liquidity and system and control. That is also introduced. Then consolidation supervisory financial conglomerates, then recasting role of statutory auditors and strengthening internal audit, then strengthening of corporate governance. These are the things going on. Then technical related, then Infinet, it is a backbone of the banking system. Then introduction of the NDS, negotiated dealing system for trading in government securities. Then promulgation of the Payment and Settlement Act, as I told you, 2007. Setting up on the establishment of the CCIL is also based on the Act. Then introduction of various services, that is RTGS, NEFT, ATM, ECS, then internet banking, mobile banking, e-commerce, then IMPS, that is immediate payment system, payment service, then unified payments interface, UIP, etc. Because all the things are taking place one by one. That is in tune with the reforms. Reform started in 1991 based on the committee decisions. Also, in between also various subcommittees, everything is there, but things are going. Then comes the setting up of the Financial Sector Legislative Reforms Commission. See the institutional framework. The institutional framework for institutional framework of banking sector was built up over a century ago. There are about 60 acts and multiple rules and regulations which were introduced even decades ago, which were introduced in decades ago, when the landscape of the banking was entirely different than that of today. So it was felt very much essential that it should be reframed. So the government has set up this FSLR, or we can call it as Financial Sector Legislative Reforms Commission, or FSLR. For our discussion purpose, we call it as FSLR-C. And FSLR-C, it was felt that the government felt that there is a commission should be set up to review and coordinate the improved, that's a compact, we can say that a compact legislation to overcome what are the bottlenecks in the existing system. Because this the compact legislative system in contemporary with that of the changes that are taking place in the financial sector. Because this act and everything was framed or in the very long ago. That was the reason. So it was set up. This FSLR-C, Financial Sector Legislative Reform Commission, was set up in March 2011. Prior to that, FSDC was set up in December 2010. Now, this committee, they have, after analyzing all the things, they have come out with the draft financial code, wherein what is the purpose or objective of this one? To review comprehensively and comprehensively and redraft the legislations governing the India's financial system in order to evolve a common set of principles for governing the financial sector regulatory institutions. This is what the objective, that is, review comprehensively and redraft the legislations governing India's financial system in order to evolve a common set of principles for governance of financial sector regulatory institutions. Then this committee or this commission, FSLR-C, after analyzing all the things, they have come out with to begin with, they have come out with the draft financial code, FSLR-C code. We can say that FSLR-C code. So this code contains some 9 component or 9 elements, very important elements, which according to the FSLR-C, they are very much essential, and those things are to be implemented so far as all financial institutions are concerned. The elements include the 9 elements. 9 elements are there. They are: one is customer protection. Elements customer protection. We can say that consumer protection. That is a word given, consumer protection. The code states that, the code insists that the regulator should ensure that the financial firm are doing enough for consumer protection. The regulators to ensure that the responsibility is with the regulators only. The regulators to ensure that the financial firms are doing enough for consumer protection. For that, excuse me. For that, the code itself gives, or code itself states, given some certain basic rights for the financial consumers. They're establishing certain basic rights for the financial consumers. And side by side, they also suggested the code emphasizes, or code gives, give the direction not direction, code advises or code emphasizes for creation of a unified financial redressal agency. Financial redressal agency, that is known as FRA. The creation of a please remember the creation of a unified financial redressal agency. That is one of the areas of the architecture. We can say that regulatory architecture of FSLRC. Now, another area, another element is macroprudential regulation. That is a regulator. Regulators have to monitor to reduce the failure probability of financial firm. They will have to monitor and to reduce the failure probability of the financial firm. That is second aspect, second element. For that, the code itself gives certain powers, provides certain powers, which are to be exercised by the regulators. The 5 powers are given. 5 powers are stated in the code. They are regulation of entry, regulation of risk taking, regulation of loss absorption, regulation of governance and management, and lastly the monitoring and supervision. These are the powers given, powers stated or given in the financial code, the FSLRC financial code. Then the third element, so far as code is concerned, the resolution. That here also the regulator, the duty regulators are to ensure that the firms should swiftly wound up in case of financial failure. They should not hold on. The regulator should ensure that the firms, that is the firms should be swiftly wound up in case of financial failure. Then creation of a unified resolution corporation. This is another this part of the architecture, regulatory architecture of FSLRC, that is creation of a unified resolution corporation. Then here again it is stated that the DICC presently giving guarantee and other thing, so far as the credit is concerned, the DICC should be subsumed into the resolution corporation. DICC should be subsumed within the resolution corporation. So another area, another element, so far as this code is concerned, there is the regulator should see that here the FSLRC does not hold a view, that they are not stating anything, the sequencing of timing, timing and capital account regularization. Then implementation of capital control should be on sound footing, but it says that whatever this control says, it should be on sound footing and should be implemented by RBI. That is then systemic risk. So that is, the regulator should see that undertake reduction in the systemic risk for entire financial system, establishment of FSDC as statutory agency. Then another area is, another element is development and redistribution. The regulator should develop market infrastructure, and the redistribution policy should be by the Ministry of Finance. Then monetary policy, the law should establish the accountability aspect, mechanism for monetary policy. Then Ministry of Finance to define quantitative target, and RBI will monitor with various tools for the purpose. Then establishment of an executive monetary policy, that is presently it is there. The public debt management, establishment of specialized framework for public debt management, strategy for long-run low-cost financing, a single agency to manage the government debt. Then contracts and other thing, contracts, trading and market abuse, establishment of legal foundation for contracts, property and security, this one. Then what is a regulatory asset? RBI, we can again, nutshell we can say that RBI should continue monetary policy, regulation and statutory agency for systemic risk and development. Then merging of the CB, Forward Market Council, IRDA and PFRDA, that is merged into one entity, that Unified Financial Agency, UFA. That is yet to take place. Regulation of supervision of all non-bank and payments related markets. Then Securities Appellate Tribunal is there presently. That should be converted, renamed to Financial Security Appellate Tribunal to hear the appeals against RBI, and UFA is going to be set up, UFA and FRA. Then DSEC we already discussed, it should be subsumed with the Resolution Corporation. Resolution work across the entire financial system. Then FSDC, they said that this systemic risk should be taken care by a statutory agency. That is no one other than FSDC. The FSDC will continue, but statutory agency for systemic risk and development. The new entities also was suggested here, but a debt management agency, an independent debt management agency, and similarly FRA, financial redressal agency, FRA. Now coming to in nutshell, these are all these changes suggested are known as the FSLRC regulatory architecture. Okay, and the report, the FSLRC report is considered to be the most important, well-researched, well-published reports in Indian financial history. Lays down functions of the financial sector, how it should be structured, and how legislation and regulation governing it ought to look like. That is another this overall view. The logic for regulation according to FSLRC to deal with market failure, more colloquially bad behavior. The danger of excessive legal framework, legal oversight. The danger of excessive legal oversight, regulatory judgment as well as policy decisions is to be subject to legal appeal. Regulatory architecture, merging all regulations of trading under a new unified financial agency. These are the observations of the FSLRC modified code or FSLRC report. So friends, we have seen that what was the financial repression the banks were facing prior to 1991-92. Then the reform started in 1991-92 based on the committee setup, that is Narasimhan Committee, that is one, set up in 1991-92. And what are the outcome of this one? CRIR introduced, SLR everything reduced. Now we have also seen that the various reforms taking place we have dealt with the banking sector, leaving all other sectors without touching all other sectors.